we saw that various peculiar scenarios may arise in the process of issue of shares. These include calls in arrears, calls in advance, oversubscription or undersubscription, issue of shares at a premium or at a discount, and issue of shares for consideration other than cash. Out of this, we discussed calls in arrears in detail in our previous video. Now, let us discuss calls in advance in detail. When shareholders pay a part or whole of the amount of calls which are not yet made by the company, such amount paid in advance are called calls in advance. Such amount which is not yet due to the company from the shareholders but still received is a liability to the company till the company makes calls in this regard and is disclosed as other current liabilities under the head of current liabilities on the liability side of the balance sheet. The company has to make appropriate accounting treatment for the calls in advance, which are received first and adjusted later on. The accounts that are opened or affected in the process of accounting for the calls in advance are bank account, calls in advance account, share call account, interest on calls in advance account, and sundry shareholders account. The company has to pay interest to the shareholders who have paid the call amounts in advance to the company. When the articles of association stipulates interest, then the company pays interest from the date of receipt of calls in advance up to the date when such amount is due for payment at the rate stipulated in the articles. However, if the articles of association is silent about the interest to be paid on calls in advance, then interest is paid at a rate of a maximum of 6% per annum. When a company receives the amount of calls in advance, it has to be recorded. The bank account is debited with the call amount received in advance, and the calls in advance account is credited with the same, thereby creating the calls in advance account. Bank account is debited since company received the money. Calls in advance is credited since it is a liability to the company till such amount becomes due, and with the credit, a credit balance is created in the calls in advance account, which can then be set off when the call actually becomes due. When the amount received as calls in advance becomes due because of the company making the call, then the balance in the calls in advance has to be transferred to the share call account. This is done by debiting the calls in advance account with the amount that was received in advance but has now become due, and a credit is given to the share call account. The calls in advance carried a credit balance when it was received, and it was a current liability. However, when it is due, it moves from current liability to share capital. So, a debit is given to set off the credit balance in the calls in advance account, and share call is credited with the figure that is to be transferred from the calls in advance to the share call account. When the company pays interest on calls in advance, it is accounted by debiting the interest on calls in advance account with the amount of interest paid by the company, and corresponding credit is given to the bank account. Interest on calls in advance account is debited since such interest is an expense to the company. On the other hand, bank account is credited since money goes out of the company. We saw the journal entry where interest is paid. However, sometimes the company may first record the interest that is due from the company to the shareholder and then pay the interest. This is recorded by first accounting for the interest being due by debiting the interest on calls in advance account with the interest amount that is due for payment and crediting the sundry shareholders account. The interest on calls in advance account is debited since it is an expense to the company, and sundry shareholders account is credited since such interest is due to be paid to the sundry shareholders and a liability is created against them. Later, when the interest is paid, the sundry shareholders is debited with the interest amount paid, and the corresponding credit is given to the bank account. The sundry shareholders are debited since they are receiving the interest, and the bank account is credited since the company is paying out the money.